Hello and welcome to this very special mutual fund report card. Joining me, two of India's finest fund managers, Dhaval Dalal, who's the head of fixed income at DSP BlackRock, who manages its fixed income funds, and also joining me is Kenneth Andrade at IDFC. Plus, like always, we've got from CRISIL, Jiju Vidyadharan, who's the head of funds and fixed income research. Thank you very much, gentlemen. Let me first come to you, Kenneth. It's been a tough quarter as far as equity funds were concerned. What were you really doing? How were you managing?
Was it? Actually, I think headline index numbers look relatively flat, but there's lots of things undergoing a big change, dramatic change on the underlying, and you've got components of the market actually giving you absolute returns. So if you've been there, it's been a good time, but there are a lot of participants coming in at this point in time, and as on date speaking, it's not been a bad journey.
Okay. Dhaval, how difficult or easy was it for you to manage your funds in this last quarter?
I think the last quarter was pretty good, given the fact that most of the market participants expected some sort of easing by the RBI, both on liquidity as well as on rates. And to a certain extent, the Reserve Bank of India has eased liquidity, which has resulted in some sort of a decline in interest rates. Now the expectations are building up for more rate cuts going forward, and that should keep the momentum going.
Okay, Jiju, let me come to you to first sum up your findings on both the equity as well as on the debt side. What was the CRISIL findings on the mutual fund rankings? Who were the ones who really performed in terms of the strategy, both in equity and debt?
Yeah, so let me first speak about equity. So within equity, what we've really seen over the last quarter is, that mid-cap funds have really done better than large cap and diversified categories. So within the funds universe per se, it's mid-cap funds that has done well. If you were to compare the performance of funds vis-a-vis benchmarks, both mid-caps as well as diversified funds have actually done better than their benchmarks. In case of large cap funds, this is of course the fund category as an average. Large cap funds have been slightly lower in terms of performance as compared to the Nifty, which is the benchmark for the large cap oriented category. In case of debt funds, on the other hand, what we've really seen is income funds doing the best out of all variants of debt categories that are there in the market. And we've also seen some degree of investor interest in case of the dynamic debt category.
So let me come to equity funds first. What CRISIL says is that those with a higher exposure to the banking and financial services, consumer non-durables and capital goods sectors, and lower exposure to IT and metals improve their rankings. Was that a strategy you followed as well?
Yeah, we've been out of the commodity space for some time. IT, I think if you break it up between the large caps and the mid caps, performance in the last quarter, if you're talking just about our quarter numbers, is pretty okay. But overall, the development as far as the corporate sector is concerned, I think profitability in a couple of sectors are tearing higher, and essentially market caps are representing that. So our sense is that you're very much a consumer-focused economy. That's where the strength is. That's what's driving your current economic activity, and the underlying profitability is there for the taking. So money is migrating towards that spectrum of the market. So yeah, to be fair, we've been in that space.
Okay, so you would say that you've been more in the defensives, or you've started moving out from that?
I mean, what's defensive and what's cyclicals? Okay, these are structural businesses. They've always been around. The only difference is today they're having a higher growth rate than the rest of the market. So if they're having a higher growth rate against the market, I mean, money usually polarizes itself towards faster growing economies or faster growing companies. And that's essentially what's happening. So even in the banking space, if you look at the market, or the financial space, if you look at the market, money is moved towards private sector and the NBFCs, which are retail driven. Okay, institutional funding or infrastructure funding is something that money is not really attracting too much of capital for the delinquencies in the system. So that's the polarization of capital that's taking place, and you pushed valuations to an extent where some of them it's hard to fathom as to why they are at these extremes. But there are opportunities on both ends now.
One of the flights that we did see was, or has continued to be, flight towards safety, isn't it? At least as far as the Indian retail investor is concerned. Dhaval, have you started seeing any renewed interest into debt funds from the retail investor?
In fact, that has been a reversal in the trend away from safety. In 2011, we have seen that most of the investors were preferring safety. That means in liquid funds as well as fixed maturity plans as interest rates were rising. In early part of 2012, we have started seeing a little bit of reversal, wherein we are seeing investors now looking to get out of short duration funds and looking to invest in long duration funds such as short-term funds and income funds. I think that's a welcome change, given the fact that we have been pushing the investors to consider income funds as an asset allocation funds, and now I think our efforts are bearing fruits.
And what's the kind of returns that these funds have given so far? I'm not asking you for future, but what have they delivered so far?
I think given the interest rate scenario that we had in 2011 and the investors' horizon, I think most of the investors have made very good risk-adjusted returns in last 1 year.
But how much? What is your fund delivered?
I think between 9 to 10%.
9 to 10%.
It's a different sectors of the funds have delivered this kind of returns.
And you started seeing a lot more retail interest?
I think investor interest is across the board, and I must say that both HNI as well as retail is now warming up to adding more of fixed income.
Jiju, is that really the evidence that your study throws up as well? Where has retail money really been moving? Have we started seeing money flowing into equity funds in a more bigger way?
So really in terms of equity funds, what we've really seen is some degree of money moving into the mid-cap space. In case of debt, on the other hand, as I mentioned, dynamic debt funds seem to be catching a lot of flavor, and I think it's also to some extent attributable to the interest rate scenario, and also to that extent the short-term uncertainty really in terms of interest rates, because of which investor interest seems to be increasing towards funds which manage duration in a dynamic way. So these are the two categories, at least over the last quarter, where we've really seen asset flow.
He talked about mid-cap funds, Kenneth. You've run a few of them yourself and they've been very good performing funds. Is the tilt more towards mid-cap for you as a fund manager right now, in terms of the fact you made the point earlier that some of the big frontline companies are very overvalued or expensive, let's put it that way?
Okay, I mean, our bias has been towards growth companies, okay, and we like businesses that actually grow. So that's essentially where we allocated capital to. But there are parts of the market which are still reasonably valuable, okay, and I think...
Which parts are these?
Okay, let's put it this way. If you look at sectoral indices, one thing that's been a complete flyer is the auto index, the consumer non-durable index, and the FMCG businesses. Okay, they've been complete flyers. Then you have the pharmaceutical businesses, which are completely there. So these are all very efficient structures that are in play. Today, for me to justify the valuations currently on historical earnings will be a little difficult. Is there a growth in the underlying market? Yes. If you take a longer-term approach to investing, these are stable businesses. They've got brand pull. They've got assets on the ground which can't be replicated very soon, etc. So they will be reasonably steady state at that point in time, and this is largely an ancillary part of the Indian economy, which is why they are not there in the headline index. So if you look at all the names that sectors we put together, not too many companies are in the headline index. All of them happen to be a large part of the mid caps or the mid cap part of the market, and that's essentially what's held through the entire cycle. So this is where we are currently. If I flip it over and actually look at the financials, like I mentioned some time back, it's a little difficult to realign yourself to the thought process of the private sector, the differential in valuations between the private sector bank and the public sector banks. Okay, the public sector banks today, they're bearing the brunt of of the investment cycle, so as to say between 2007 to 2011 and into 2012, and in 4 years from today, they will actually clean up their entire act. So I think there's lots of value out there sitting there. I mean, when I talk about value, I'm talking about absolute value in terms of you can run stocks in that space with an absolute return kind of a criteria out there without even looking at the growth matrix of that portfolio. Likewise, for a lot of infrastructure businesses on the ground, you've got execution risks which are off the table currently. You've got raw material volatility which still remains, but that will find a solution going into the next 18 months to 2 years, and then you'll see cash flow generating out of the system. So overall, from an overall context, I think you're putting the other parts of the markets into place, but that's going to take some time. Till then, I think is what you have to the markets actually sidestepped the broader indices, moved to the so-called mid-cap part of the market, and is polarizing capital out there. So some of these companies have gone into becoming large caps, but the profitability is still mid-capish.
Okay.
Okay, and I think like in all cycles, that does emerge. Okay. The expectation levels build up in terms of how a 5-year cycle will pay through for these companies. So I think now you'll have to have a lot more patience in that segment of the market, and you'll have to broaden your horizon to saying that, especially in these kind of companies, to see as to where money can be incrementally made.
One of the things that the equity market has always been looking at is the moves that come out of RBI. You did mention that earlier, Dhaval. What is your own sense in terms of, if you were to look at today's, so first question, the liquidity situation.
Right.
There is the whole talk about, will RBI be forced to do more open market operations? That's an overhang. We've seen sharp movements as far as that the bond yields are concerned for the 10-year paper. How would you explain that in terms of what's really going on there?
See, at this point of time, the systemic liquidity has been in deficit, and judging by the current numbers, it's more than $1 trillion deficit in the systemic liquidity. So based on that, I think most of the market participants do expect the RBI to take measures to ease systemic liquidity. Some of the steps the RBI has taken is by reducing cash reserve ratio, and they've done it through conservative credit policies. However, despite that, the systemic liquidity continues to remain tight. And going by the projections in month of December, where there will be an advance tax outflow, the systemic liquidity is going to aggravate. So we do expect the RBI to announce some sort of bond purchase program, which is, we call it open market operations, which is long overdue. And that should in turn ease the systemic liquidity pressure. If you remember, the Reserve Bank of India has given a comfort that whenever the systemic liquidity will cross 1% of the NDTL, that's when they will announce the liquidity infusion measures, and the current systemic liquidity envisage that the RBI has to take some steps to ease the liquidity pressure.
What is your own sense on rate cuts?
I think I was personally expecting a rate cut in the last credit policy, but now the Reserve Bank of India has made very clear that they would like to cut rates only when the inflation begins to ease. And our projection for the inflation to ease in the first quarter of 2013. So based on that, we expect the RBI to start reducing interest rates in the first quarter of 2013 calendar year.
Is that in line, by and large, Kenneth, with what the market is expecting as well?
I think that's broadly in line.
And that could be the next trigger, according to you, for equity?
I'm not too sure if interest rates are going to drive equity valuations higher. Okay.
But in sentiment terms?
In terms of sentiment, I think the sentiment's already much better than it was at the starting of the year. Okay, these are just value adds to the entire system. I think the report card that everyone is looking for is how financials of each of these companies are going to come through. So if you broadly break up the economy right now, I think and look at the government leverage, the corporate leverage and the consumer leverage, except for the government who runs an extremely high fiscal deficit, both at the corporate level and at the consumer level, I think you've started cash flow generation. So consumer level, per capita income has been climbing for the last 7 years. At a corporate level, this is the last year of balance sheet expansion. So that leaves the government out there who's running a very high fiscal deficit. Going into election year, that's going to be higher than what you've earlier envisaged. So I think in that 3-layer part of it all, I think the government's the answer for a full-blown out bull market to come through. But that's significant time away from it. So they have to start deleveraging themselves first, or they have to cap subsidies, and subsidies is going to be a significant part of the market this year, and then we'll have to see how finances evolve itself.
Jiju, how, according to you, have the whole AUMs of various schemes evolved in the quarter gone by that we are discussing?
In terms of AUM flow, while it's largely been static, mid-caps, as I spoke of earlier, is one category where there has been some degree of interest, so that it's grown by about 11% in terms of assets under management. The other, category which continues to see interest in terms of size is liquid. So liquid followed by ultra short. On the long end, it is at this point of time it is dynamic debt funds which are seeing interest. Gilt funds, on the other hand, seem to have seen some degree of profit booking, which is a little strange, but there has been some decline really in terms of gilt AUM over the last quarter.
How would you explain that?
Well, I think if you look at the MF data and the latest month, that is October, our observation is that the gilt funds do have got net inflow, although at a very low base. So the gilt funds normally cater to the opportunistic institutional investors who would like to come with a very short and definite view on interest rates. And since there were expectations of the rate cut, I think gilt funds have seen inflows in month of October, and that will possibly negate the outflow that Jiju was talking about on the quarter. With regards to the liquid funds, I think this category continues to grow as institutional investors who would like to protect and preserve their capital have been putting more and more money at the short end of the curve, and those who have some of the institutional investors have also begun to allocate money on long duration for such as dynamic bond fund, which is a welcome change.
What's the supply for you? Is it getting better? Are you seeing more of AAA rated bonds out there in the market? We have of course also seen simultaneously greater participation of FIIs in the bond market in that sense. How is the supply for you when you go out to buy?
In fact, this year we have seen a dramatic change in the composition of supply, and to a certain extent the regulatory changes such as sector caps have also helped mutual funds diversify their holdings away from the traditional purchase area of NBFCs and housing finance companies. Now I think based on the new regulations, there are more different kind of issuers who are looking to tap the capital markets, and mutual funds are catering to that. So to that extent there is a welcome change, and I believe that these steps will go a long way going forward in strengthening the fabric of the capital markets going forward.
Are your liquid funds doing better than the savings account?
Yes, definitely yes.
But you're not able to see the pull yet?
Oh, in fact, see, if you look at the liquid funds, I think more than 80 to 90% is institutional money.
Parking slot.
Absolutely. And we continue
no retail interest at all?
Very little. In fact, retail investor is there, and I think now in our sense, most of the retail investors have experienced positive experience the FMP business of most of the mutual funds, and they have successfully taken the assets of fixed maturity plans last year to a new high. Now as and when the fixed maturity plans are maturing, they are asking for rollovers as well as looking to deploy that money into long duration funds. So mutual funds have been successful in catering to some of the demands of the retail investors by way of offering them fixed maturity plans when interest rates were high. All now we have to do is to capitalize on these investors to ask them to consider different funds.
Kenneth, the SIP route continues? You continue to see good popularity there? Are you seeing STPs as well?
SIPs and STPs have been a mainstay for a long time now in the equity business. Given the fact that returns have been very volatile across the year, I think the largest amount of money coming through in the system is SIPs and STPs.
You continue to see interest in?
We're seeing some kind of lumpy inflows, but I think on the other side also, with NAVs hitting all-time highs, all the patient investors of the last 5 years or 6 years, we've seen a fair amount of profit booking coming through also.
Okay. All right, gentlemen, thank you very much, both of you, for joining us. Jiju, thank you very much as well for coming by and giving us a sense of the quarter gone by. Well, that was our special discussion with two of India's best fund managers. We'll of course be back next quarter and discuss the mutual fund report card again. Thank you very much.